The Trump administration has ramped up its criticism of India's purchase of Russian oil. In what is Washington's strongest criticism so far, the White House's Deputy Chief of Staff, Stephen Miller, accused India of effectively financing Russia's war in Ukraine.
In August 2025, China significantly reduced its imports of crude oil from the United States. This wasn't announced in an official statement or through a major policy speech. There were no public warnings or threats of sanctions. Instead, the decline happened quietly. Import levels, which had previously reached about 160,000 barrels per day, dropped to almost zero within a matter of weeks. Analysts observed the change in trade flows through shipping data and customs reports rather than government press releases.
Chinese have completely grind the imports to a halt in August. We expect also very low imports of U.S. crude oil into China next month.
The shift came shortly after China introduced a 10% tariff on American crude oil. While modest compared to earlier rounds of tariffs seen in global trade disputes, this additional cost appeared to be enough to push U.S. oil out of China's purchase plans. In practical terms, it priced American barrels out of the market at a time when China was diversifying its suppliers and securing better terms elsewhere.
The senior Trump aide said that U.S. President felt that New Delhi's actions were unacceptable. In fact, U.S. President Donald Trump has continued to threaten to impose secondary sanctions on buyers of Russian oil. A decision on the matter is expected on Friday. If U.S. does impose sanctions, India's oil import bill could rise by $9 to $11 billion per year.
The impact of this sudden halt was felt most immediately along the Gulf Coast of the United States. Major export hubs such as Corpus Christi and Houston, which had invested heavily in facilities to handle shipments to Asia, reported a noticeable slowdown. Terminals that had recently expanded their capacity were left underused. Storage tanks that once turned over weekly began sitting half full. Pipelines feeding these export facilities operated below normal throughput, with some operators reportedly curtailing flows due to weak demand.
Remember, Russian crude oil accounted for 35% of India's total imports in the first half of 2025. However, India's crude oil imports from US are set to rise by over 150% in FY26. Sources telling us that imports in the first quarter of the fiscal already rose by 114%, with share of US crude in India's import basket rising from 3 to 8% in July alone. Furthermore, government sources maintain that India's purchase of Russian oil is critical to maintaining price stability. Sources added that India followed international protocols while buying from Russia. Brent spiked on fears of Russian oil going off the market in 2022. Sources have said that India's increased oil imports from Russia stabilized prices.
This was not a small or isolated change. While 160,000 barrels per day is not enormous relative to total U.S. oil production, it was a consistent and reliable trade route that justified billions of dollars in infrastructure spending over the past decade. Ports along the Texas coast had expanded specifically to accommodate very large crude carriers, and pipeline operators had laid new connections to bring oil from inland production zones to export terminals. These investments were made under the assumption that Chinese demand would remain a central part of America's energy export strategy for years to come. When China stepped away, there was no immediate alternative buyer of equal scale. Europe, India, and South America each import crude, but their needs and pricing expectations differ. Many of these markets also have long-term supply contracts with other exporters, limiting the ability of U.S. companies to redirect barrels quickly. As a result, American exporters faced both logistical and pricing challenges almost overnight. Observers pointed out that China's move did not appear to be purely reactive or symbolic. Rather, it reflected a longer-term strategy to diversify supply lines and reduce exposure to U.S. policy risk. For years, Chinese officials had expressed concerns about relying too heavily on American commodities, particularly in sectors like energy, where geopolitical tensions can lead to sudden disruptions. By securing more supply from countries such as Russia, Saudi Arabia, and Iran, China reduced its vulnerability to U.S. sanctions and tariffs, while also negotiating more favorable terms. For the United States, the timing was especially difficult. The domestic energy sector had already been navigating fluctuations in global demand, shifts in shipping routes, and debates over environmental regulations. The sudden drop in Chinese purchases added another layer of uncertainty, particularly for Gulf Coast exporters whose business models had centered on Asian markets. At the political level, the reaction was muted at first. There was no immediate acknowledgement from the White House about the decline in exports to China. Trade officials described the situation as part of broader global market adjustments rather than a deliberate move by Beijing to target American oil. However, energy analysts and market commentators quickly connected the dots, noting that the 10% tariff introduced by China aligned closely with the drop in purchases. This development also highlighted how global energy trade can shift without dramatic headlines. Unlike sanctions or embargoes, which are typically accompanied by public announcements and diplomatic protests, changes in purchasing patterns often happen quietly. A single tariff adjustment or new supply agreement can reroute millions of barrels without a single formal declaration. The result is the same. Facilities that were once busy handling exports can fall silent within months. The scale of investment at risk underscored why this shift mattered. Over the past decade, the United States had spent billions of dollars building out infrastructure aimed at supporting energy exports, particularly to Asia. This included the construction of new pipelines from shale production areas in West Texas to coastal terminals, the dredging of shipping channels to accommodate larger tankers, and the expansion of storage facilities near ports. These projects were justified by projections of sustained demand growth from major importers like China. With that demand now absent, at least in the short term, the economic calculus changed. Port authorities and energy companies faced difficult decisions about whether to scale back operations, seek new markets, or repurpose facilities. Some operators began exploring options to redirect shipments to Europe and Latin America, though these markets are smaller and often require different logistical arrangements. The broader geopolitical context also played a role. The United States had previously positioned itself as a major player in global energy markets, particularly after the shale boom transformed it from a net importer to a significant exporter. This shift was framed by policymakers as a source of leverage in international trade and diplomacy. Losing access to one of the world's largest buyers challenged that narrative and raised questions about the durability of America's role in the global energy system. China's decision to reduce American imports did not occur in isolation. Around the same time, Chinese officials were finalizing long-term supply agreements with Russia and Iran, two countries that had been facing varying levels of U.S. sanctions. These deals often included flexible payment arrangements, such as settlement in Chinese yuan rather than U.S. dollars, further reducing reliance on American financial systems. By diversifying both supply and currency, China gained more insulation from potential U.S. policy changes. Market analysts noted that even a modest tariff can have outsized effects in commodity markets. Oil is a globally traded product with prices that fluctuate daily, and even small cost differences can determine whether a shipment is profitable. A 10% tariff, when combined with transportation costs and other logistical considerations, was enough to make U.S. crude less competitive compared to alternatives from Russia, the Middle East, and Africa. The drop in exports also affected U.S. storage dynamics. Facilities that had been operating near capacity began reporting higher inventories, which in turn pressured domestic prices. Lower prices squeezed producers, especially smaller companies with higher production costs. Some firms scaled back drilling plans or delayed new projects, waiting to see if alternative markets would emerge. While some American barrels found buyers in Europe and India, these markets could not fully absorb the volumes once shipped to China. European refiners already had established suppliers and were negotiating their own discounts amid a crowded market. India, meanwhile, had increased its purchases of discounted Russian crude, leaving less room for American oil. This realignment of trade flows revealed how quickly global energy markets can adapt to new conditions. Within months of the tariff's introduction, Chinese refineries had adjusted their crude blends and shipping schedules to accommodate alternative suppliers. American exporters, in contrast, were left scrambling to reconfigure their distribution networks. The shift also served as a reminder that energy trade is not purely about economics. Political considerations, currency arrangements, and long-term strategic goals often shape decisions in ways that aren't immediately visible in price charts. In this case, China's pivot away from U.S. crude was as much about reducing geopolitical risk as it was about securing cheaper barrels. For communities along the U.S. Gulf Coast, the slowdown was visible in everyday activity. Fewer tankers arrived at ports, truck traffic declined, and local businesses tied to the oil export sector reported lower demand. While the broader U.S. economy remained resilient, the regional impact was significant, particularly for areas that had invested heavily in export infrastructure over the past decade. The most significant aspect of this shift was the rapid expansion of supply contracts with Russia, Saudi Arabia, the United Arab Emirates, and Iran. These producers already accounted for a large share of China's imports, but new agreements signed in early to mid-2025 deepened those ties. Market data showed increased tanker traffic from Russian and Middle Eastern ports to China's eastern refineries. Industry analysts noted that these agreements were not just about price. They included flexible payment terms, long-term commitments, and infrastructure support that allowed Chinese refiners to integrate these supplies seamlessly. One of the most striking features of these contracts was the move away from the US dollar. Traditionally, oil has been priced and traded globally in dollars, which gave the United States considerable influence over energy markets. By shifting to yuan-denominated contracts, China began removing that leverage. Transactions settled in yuan bypassed U.S. financial systems entirely, insulating both buyers and sellers from the risk of American sanctions or currency fluctuations. This transition to yuan-based trade was not sudden. For several years, China had been encouraging its trading partners to accept payments in its own currency, particularly through initiatives like the Belt and Road. However, the events of 2025 accelerated this trend. Once the initial agreements with Russia and Iran were finalized, other suppliers followed suit. By mid-year, a growing portion of China's crude imports were being settled outside the dollar system, signaling a structural shift in global energy finance. For Chinese refiners, the transition was not merely about avoiding political risks. Paying in yuan also simplified transactions for domestic companies, reduced foreign exchange costs, and strengthened the international role of China's currency. From Beijing's perspective, this supported broader economic goals, building financial resilience and increasing the yuan's standing as a global reserve currency. On the logistical side, China's pivot required adjustments to its refining and transport infrastructure. American crude, particularly the light sweet grades produced in U.S. shale regions, has different properties compared to Russian and Middle Eastern blends, which are often heavier and more sulfurous. Refineries must be configured to handle specific types of crude, and changing supply sources can involve significant modifications. Reports from industry observers indicated that several Chinese refineries underwent upgrades or reconfigurations to better process these alternative blends. This was not a temporary workaround but a structural adaptation, indicating that the shift away from American oil was expected to be long-term. Iran played a unique role in this realignment. Despite ongoing U.S. sanctions, Iran continued to export substantial volumes of crude through what industry insiders call the shadow fleet, tankers that operate under obscure ownership structures, often using flags of convenience and altered documentation to obscure the origin of their cargo. Chinese independent refiners, known locally as teapots, became significant buyers of this oil. These smaller refineries are less tied to state procurement systems and more flexible in their sourcing, making them well-suited to handle discounted crude that might carry political risks for larger state-owned firms. The volumes involved were substantial. By mid-2025, estimates suggested that China was importing roughly 1.7 million barrels per day of Iranian crude, a dramatic increase compared to previous years. This figure dwarfed the volumes once purchased from the United States and positioned Iran as one of China's top suppliers. For Tehran, this provided a vital outlet for its oil exports at a time when access to Western markets remained heavily restricted. For Beijing, it meant securing cheap supplies outside the reach of U.S. financial and diplomatic influence. Russia also deepened its energy ties with China during this period. Following Western sanctions related to its ongoing conflicts and geopolitical disputes, Russia had increasingly turned eastward to sell its oil and gas. China became a willing buyer, capitalizing on discounted prices and long-term contracts that guaranteed stability. New pipeline routes, including expanded capacity on the Eastern Siberia Pacific Ocean (ESPO) pipeline, facilitated higher volumes. Tanker shipments from Russian Far Eastern ports also increased, further integrating the two countries' energy networks. Saudi Arabia and the UAE maintained their roles as key suppliers as well, but even these relationships evolved. While they continued to price some contracts in dollars, they were increasingly open to accepting yuan, especially for sales to Chinese state-owned firms. These Gulf producers sought to diversify their customer base and reduce reliance on Western markets, particularly as global energy demand patterns shifted toward Asia. For the United States, this new landscape represented more than just the loss of a major buyer. It signaled a weakening of one of its long-standing advantages in global trade, the dominance of the dollar in energy transactions. For decades, the so-called petrodollar system had bolstered American financial influence, as countries needed dollars to purchase oil and often recycled those dollars into U.S. assets. The gradual emergence of a petro-yuan alternative chipped away at that foundation. Economists cautioned that this shift would not overturn the dollar's status overnight. The dollar still accounted for the majority of global reserves and trade settlements. However, even incremental moves away from it can have long-term consequences. Each contract signed in yuan, rather than dollars, represented a small reduction in the demand for U.S. currency and a marginal increase in China's financial autonomy. The broader implications extended beyond finance. Energy trade often underpins diplomatic relationships. By securing more oil from Russia, Iran, and Middle Eastern partners, China deepened ties with countries frequently at odds with U.S. policy. This alignment allowed Beijing to position itself as a central player in alternative trade networks that bypassed American influence. Meanwhile, the U.S. found itself facing structural challenges in re-entering the Chinese market. Even if tariffs were removed, the logistical changes made by Chinese refiners created new barriers. Ports, pipelines, and storage facilities had been adapted to handle non-American grades of crude. Payment systems had shifted toward yuan. Reintegrating American oil into this system would require not just competitive pricing, but also renegotiation of technical and financial arrangements. This reality underscored how quickly energy markets can evolve. Decisions made in boardrooms and government offices often translate into physical changes in infrastructure, which are far more difficult to reverse. Once refiners switch to a different blend of crude and adjust their equipment accordingly, reverting to previous supply arrangements can be costly and time-consuming. Critics of U.S. energy policy argued that the country had been slow to anticipate these shifts. While Washington focused on tariffs and short-term trade disputes, other nations were building new alliances and infrastructure that would outlast any single administration. The emphasis on bilateral trade battles, rather than long-term strategy, left American exporters vulnerable when global market dynamics changed. China's pivot also highlighted the increasing complexity of global energy flows. Rather than a single dominant market or currency, the world was moving toward a multipolar system in which multiple suppliers and payment mechanisms coexist. This fragmentation can reduce the ability of any one country to exert control, but also introduces new uncertainties for businesses and policymakers. By mid-2025, it was evident that China's strategy was not simply about replacing one supplier with another. It was about reshaping the architecture of its energy security. Long-term contracts, diversified suppliers, yuan settlements, and logistical adjustments combined to create a system less dependent on any single partner. This provided Beijing with greater flexibility in navigating geopolitical tensions and responding to market shocks. One of the most visible examples of this realignment came from India. As the world's third-largest oil importer, India's decisions carry considerable weight in global markets. Throughout 2025, Indian refiners significantly expanded their purchases of Russian crude, capitalizing on the discounts offered by Moscow as it sought new outlets for its exports amid Western sanctions. In July of that year, India signed a series of long-term contracts with Russian suppliers that locked in favorable prices and secured transport routes that bypassed traditional choke points like the Strait of Hormuz. These deals were notable not only for their size, but also for their structure. Many were denominated in currencies other than the US dollar, including the Chinese yuan, and in some cases, the Indian rupee. This move away from the dollar reflected a growing trend in global energy markets. While the dollar remained dominant, the rise of alternative settlement arrangements suggested that more countries were willing to experiment with non-dollar trade, particularly when dealing with suppliers outside the Western financial system. For India, using yuan or rupees for energy purchases offered a way to shield itself from currency volatility and reduce exposure to potential US sanctions. For Russia, it provided a means of continuing exports despite financial restrictions. Southeast Asia followed a similar trajectory. Countries such as Malaysia, Thailand, and Indonesia began adjusting their procurement frameworks to allow for greater flexibility in supplier choice and payment methods. These nations were not abandoning the dollar entirely, but they were creating options. Refiners in these countries expressed interest in contracts that offered competitive pricing and adaptable payment systems, especially those that could switch between currencies depending on market conditions. The practical effect was a gradual erosion of the dollar's monopoly in regional energy trade. Europe's response to the shifting energy landscape was more complex. The continent continued to import significant volumes of American crude, particularly as it sought alternatives to Russian supplies in the wake of geopolitical tensions. However, European buyers also used the increased competition among suppliers to negotiate better terms. By mid-2025, reports indicated that European refiners were pushing for price concessions, extended payment windows, and insurance waivers. In other words, Europe was leveraging the new multipolar energy market to its advantage, extracting benefits from suppliers eager to maintain or expand their share of the market. The United States, once at the center of global oil flows, found itself increasingly sidelined in these developments. The loss of the Chinese market was a major blow, but the larger concern was the perception that American energy exports were less indispensable than before. As new supply chains emerged, U.S. crude became one option among many, rather than the default choice for large importers. This shift had profound implications not only for energy companies but also for U.S. foreign policy, which had long relied on the strategic influence conferred by its role in global energy markets. Infrastructure along the Gulf Coast illustrated the consequences of this transition. Ports like Corpus Christi and Houston had been expanded to handle large-scale exports, with pipelines and storage facilities designed to move shale oil efficiently to overseas buyers. When China withdrew from the market, those facilities were left underutilized. While some of the displaced volumes were redirected to Europe and Latin America, the scale of those markets was far smaller than what China had represented. This left parts of America's export infrastructure operating below capacity, raising questions about the long-term viability of investments made during the height of the shale boom. Industry analysts warned that this was not simply a short-term setback. The changes underway in global energy trade appeared structural rather than cyclical. New supply routes, new financial arrangements, and new diplomatic alignments were forming that would be difficult to reverse. Once refiners reconfigure their facilities to handle different crude grades, and once financial systems adapt to non-dollar settlements, switching back is neither quick nor cheap. The competitive advantage the United States enjoyed during the early years of the shale revolution was being eroded by these new realities. The narrative of energy dominance that had gained traction in U.S. political circles during the 2010s was now being tested. That concept was built on the idea that America's surge in oil and gas production would translate into enduring global influence. For a time, rising exports seemed to validate this belief, with the United States becoming a leading supplier to both Europe and Asia. But the events of 2025 demonstrated how quickly market dynamics can shift. Production alone does not guarantee dominance. it must be matched with stable trade relationships, competitive pricing, and the ability to adapt to geopolitical changes. Geopolitical alliances were evolving just as rapidly as market flows. China's deepening ties with Russia and Iran provided those countries with a lifeline at a time when Western sanctions were intended to isolate them. India's willingness to buy discounted Russian crude complicated efforts to present a united front on sanctions policy. Even traditional U.S. partners in the Middle East, such as Saudi Arabia and the UAE, were hedging their bets by diversifying customers and payment mechanisms. In North America, a separate but related development was underway. Canada and Mexico, long integrated with the U.S. energy market, began exploring alternative trade corridors that reduced reliance on American ports. Plans for what some analysts referred to as the Northern Corridor envisioned infrastructure linking Canadian and Mexican energy exports directly to Pacific and Atlantic markets. While still in early stages, these projects reflected a broader desire to insulate supply chains from the volatility of U.S. trade policy. This trend toward diversification had a cumulative effect. The more countries built alternative supply routes and financial arrangements, the less leverage any single country could exert over global energy flows. For the United States, this meant that tools like sanctions and tariffs, once powerful levers of influence, became less effective. If major buyers and sellers could transact outside the dollar system and bypass American ports, they were less vulnerable to Washington's economic pressure. The ripple effects of these changes extended beyond energy into broader trade dynamics. As more transactions moved away from the dollar, the currency's role in global reserves and settlement was gradually diluted. This did not mean the dollar was in immediate danger of losing its status as the world's dominant currency, but it did signal a slow shift toward a more fragmented financial system. Such a system could prove harder for the United States to navigate, particularly if competing blocs emerge with their own standards and institutions. Domestically, the implications for the U.S. energy sector were significant. Producers faced increased uncertainty about long-term demand, making it harder to justify new investments. Companies that had counted on Asia as a growth market were forced to reconsider their strategies. Some looked to Europe, others to Latin America, but none of these markets offered the same scale as China. The result was a more competitive and less predictable environment for American exporters. At the policy level, these developments raised difficult questions. Should the United States double down on efforts to regain market share in Asia, even if it requires price concessions or policy shifts? Should it focus instead on building stronger ties with Europe and other regions less aligned with China's new energy network? Or should it rethink its reliance on energy exports altogether, focusing instead on domestic consumption and alternative energy sources?